Japan's economy is a land of paradoxes. It boasts the world's fourth largest GDP, yet growth has barely flickered for decades. Prices were flat or falling for a generation, but now inflation is finally back, just as the country's debt has swollen to stratospheric heights. And in late 2025, as Tokyo's skyline glitters over an aging society, a new leader is preparing a bold economic experiment. Sanae Takaichi, a hardline nationalist often dubbed Japan's Iron Lady, has just won the ruling party's leadership and is poised to become the nation's first female prime minister. She promises to smash decades of stagnation with an Abe-style, growth-first agenda of big spending, tax cuts, and easy money. But will this high-wire act revive Japan's stalled economy or tip it into crisis? At the heart of this story is a crucial question. Can Takaichi's Abe-like playbook jumpstart Japan's economy without triggering dangerous inflation, a debt spiral, or a regional backlash? It's a gamble with enormous stakes. Japan in late 2025 is a study in inertia. After years mired in deflation, the economy has finally crept out of zero-price growth, but not by much. Core consumer prices, which exclude fresh food, are rising around 2 to 3% year-on-year, a remarkable change for a country once synonymous with falling prices. In fact, September 2025's core CPI was forecast to climb 2.9% from a year earlier, marking the first uptick in 4 months as higher food and energy costs linger. This means Japan has now seen inflation above the Bank of Japan's 2% target for over 3 years straight, a sharp reversal from the persistent deflation of the 2000s. Yet by global standards, 3% inflation is modest. Japan has emerged from its deflationary spiral only to find itself stuck in a low-growth, low-flame equilibrium. Economic growth remains anemic. Even with prices rising, Japan's GDP expansion hovers around 1% or less per year in real terms, a far cry from the heady days of the 20th century economic miracle. Consumption and investment are subdued, periodically knocked by global slowdowns. The population is aging and shrinking, undermining the workforce and domestic demand. Japan's median age is over 48, and each year the country loses about 500,000 people as births languish and lifespans extend. This demographic drag means that even when total GDP inches up, per capita gains are hard-won, and the burden on social security grows heavier. A glance at the past decade shows an economy that has flatlined in many respects. A few bright spots of innovation and export strength, overshadowed by weak productivity and cautious consumer spending. It is little wonder economists dub it the stalled kingdom. One area where Japan leads the world, unhappily, is public debt. After years of stimulus packages and falling tax revenues, Japan's gross government debt is about 230 to 250% of GDP, by far the highest ratio in the developed world. That figure, roughly 2.5 times the size of the entire economy, would be catastrophic in most countries. Japan has managed it thanks to unique factors: domestic investors voraciously buying bonds, and the Bank of Japan, BOJ, itself, snapping up government debt on an unprecedented scale. But the debt pile cannot be ignored. At over 250% of GDP, Japan's debt load stands out globally, and combined with sluggish growth and a shrinking populace, it's viewed by many as an existential risk. The government's annual budgets tell the story. Debt servicing costs are surging as even tiny upticks in interest rates bite. In fact, for the upcoming fiscal year, a record 32.4 trillion yen, over $220 billion, has been requested just to cover interest payments and bond redemptions, fully 1/4 of all government spending. This is new. For decades, ultra-low interest rates made Japan's debt mountain seem almost cost-free, but now that era is ending. Today Japan teeters between stimulus and strain. Consumer prices are finally rising instead of falling, which is positive. No one wants to return to deflation, but inflation is just high enough to squeeze households without igniting real growth. Wages have struggled to keep up. Unemployment is low, around 2.5%, yet so is wage growth once adjusted for prices. Real household incomes actually fell in 2023 and 2024 as inflation outpaced pay raises. And while major corporations granted the biggest nominal wage hikes in decades in the 2024 Shunto labor negotiations, around plus 5.3% on average for big firms, the most in 33 years. Much of that boost has been swallowed by higher living costs. For the average Japanese family, the past year brought the unfamiliar sting of rising grocery and utility bills, without a commensurate jump in take-home pay. Meanwhile, the yen has been under pressure. In 2022 to 2023, the yen weakened sharply against the US dollar as American interest rates climbed, while Japan's remained at rock bottom. By late 2025, the yen trades near multi-decade lows, hovering around the mid-140s to 150 per dollar, pushing up import prices. The weak yen has been a double-edged sword. It boosts export earnings for Japan's famed manufacturers, but makes energy and food, much of which Japan imports, pricier for everyone. This complicates policymaking. Stimulate too much, and the yen could slide further, fueling more inflation. Tighten policy, and you risk snuffing out the fragile growth spark. In short, Japan faces a policy dilemma as 2025 draws to a close. After 30 years of on and off recessions, deflationary traps, and false dawns, the economy is technically growing and inflation is finally on target. Yet it feels like a Pyrrhic victory. Growth is still sluggish, people feel poorer after inflation, and the nation's fiscal health is deteriorating. How do you kickstart growth in a stalled economy without kicking off a crisis? How to deliver stimulus when the government is already up to its ears in debt and the central bank's toolbox is largely spent? This is the daunting backdrop against which Sanae Takaichi steps up to the stage. Sanae Takaichi's rise to the pinnacle of Japanese politics comes at a turbulent moment. Dubbed by admirers and critics alike as Japan's Iron Lady, Takaichi, 64, has openly modelled herself on Margaret Thatcher's brash leadership style, at least in image. She beat out several male contenders in the October 2025 Liberal Democratic Party (LDP) leadership race, shattering a glass ceiling in a country long governed by older men. In her victory speech, she declared a new era for Japan, one where she promises to restore growth and pride to a nation anxious about its future. Takaichi is a polarizing figure, a hard-right nationalist on social and historical issues, yet also a protege of the late Shinzo Abe, with a penchant for expansive economics. She is often compared to Thatcher, but there's an intriguing twist. While Thatcher preached fiscal austerity, Takaichi is closer to a deficit dove. As Reuters wryly noted, Japan's leader-in-waiting is no Iron Lady in economic terms. Takaichi likens herself to Thatcher, the bold leader, but her policies align with Abe's big spending ethos. Takaichi's political identity is entwined with nationalism and conservatism. A former internal affairs and economic security minister, she is known for her hawkish views. She has made a point of visiting the controversial Yasukuni Shrine, which enshrines Japan's war dead, including convicted war criminals, regularly, something no Japanese prime minister has dared since 2013. These visits reliably anger China and South Korea, who see them as glorification of Japan's past militarism. Ahead of taking office, Takaichi has equivocated on whether she'll continue this practice as PM, but her reputation as an unapologetic nationalist is well established. She favors revising Japan's post-war pacifist constitution to strengthen the military, and even mused about a quasi-security alliance with Taiwan to counter China. Such positions thrill Japan's right wing, but raise blood pressure in Beijing and Seoul. Domestically, she opposes liberal social changes, like same-sex marriage and allowing married couples separate surnames, hewing to the LDP's traditionalist base. In short, on the political spectrum, she's on the far-right edge of the mainstream, a self-styled iron-fisted patriot in a country that has often opted for moderate managerial leaders. Economically, Takaichi is a disciple of Shinzo Abe's agenda. Abe's, who led Japan from 2012 to 2020, championed a strategy famously dubbed Abenomics, built on three arrows: aggressive fiscal stimulus, radical monetary easing, and structural reforms. Takaichi has been one of Abenomics' loudest cheerleaders. She served in Abe's cabinet and was mentored by him. Now she presents herself as the torchbearer for his vision. During her campaign, she pledged to double down on growth-first policies, even as inflation runs higher than in Abe's time. Her platform calls for stimulative tax cuts, cash handouts to households, and major public works spending to spur demand. At the same time, she talks about Japan's need for fiscal discipline, rhetorically nodding to conservative concerns about debt. But her actions and promises place her firmly in the camp of policy doves. As an analysis by EFG put it, the Iron Lady nickname ends where economics begin. Unlike Thatcher's fiscal rigor, Takaichi is expected to pursue expansive spending to boost growth. Indeed, markets immediately recognized this. After her leadership win, Japanese equities soared to 33-year highs while the yen weakened, as investors anticipated larger budget deficits and prolonged easy money ahead. Takaichi's branding as Japan's Thatcher belies an important nuance. She may emulate Thatcher's tough image and uncompromising will, but her economic stance is closer to Abe's Keynesian nationalism than to Thatcherite monetarism. Takaichi has repeatedly criticized the Bank of Japan for ending its ultra-easy policy too soon, suggesting she will resist further interest rate hikes. She has promised sizable fiscal packages, including infrastructure projects, support for families, and big boosts to defense spending, to restore Japan's strength. On the campaign trail, she vowed to make Japan's economy twice as large over the next decades, an ambition that would require sustained growth well above the meager rates of recent years. To achieve this, she signals, the government must be willing to spend and the central bank willing to accommodate. It's essentially Abenomics 2.0, pump priming the economy and hoping to spark a lasting growth dynamic, while relying on the BOJ to keep borrowing costs low. This approach has immediate popular appeal. After all, many voters are fed up with belt-tightening and stagnation. In recent elections, public frustration with rising living costs and a perceived lack of support for families hurt the prior administration. Takaichi tapped into this sentiment with straightforward promises: cash payouts and subsidies to ease the pain of inflation, and tax relief for households and small businesses. She portrays herself as a champion of the ordinary Taro, offering relief from what she calls decades of elite mismanagement. At the same time, she wraps her economic plans in nationalist language, talking of economic security, technological sovereignty, and latent strengths of Japan that she will unleash. It's a message that blends pocketbook populism with patriotic pride. Yet, lurking beneath Takaichi's confident narrative is a high degree of political fragility. Her LDP won the party vote thanks to support from the grassroots members and the conservative old guard, but the party lacks a stable majority in parliament. In fact, soon after her victory, the LDP's longtime junior coalition partner, Komeito, walked away in protest over campaign finance scandals and Takaichi's hardline tendencies. That means Takaichi could assume the premiership with a weak grip on the Diet, potentially needing opposition votes to pass legislation. A strong leader, weak numbers situation could force her to scale back or negotiate aspects of her agenda. For instance, if she needs support from a centrist or left-leaning party to govern, they might demand more fiscal caution or social concessions. Even within the LDP, veterans like Taro Aso, whom Takaichi appointed as LDP vice president, are fiscal hawks wary of unchecked spending. In essence, Takaichi talks a big game of bold policies, but she may find her wings clipped by political reality. She is walking into a balancing act, fulfill her growth-first promises to maintain credibility, while placating enough skeptics to keep her government afloat. For now, the stock market's exuberance and her supporters' enthusiasm give Takaichi a mandate to try something new, or rather, something old, revisited. She has framed it as the last chance for Reiwa-era Japan to revive itself. Her conviction is palpable, but the challenges she faces are immense. Next, we break down the core components of Takaichi-nomics, what exactly she plans to do on fiscal, monetary, and economic security fronts, and how those policies echo or diverge from recent precedent. What does Takaichi-nomics actually entail? In broad strokes, it is a continuation of Abenomics-style stimulus, tweaked for today's conditions. Takaichi's economic strategy can be viewed in three pillars: fiscal, monetary, and economic security, all underpinned by a nationalist vision of self-reliance. A. Fiscal policy: guns, butter, and bridges. On the fiscal side, Takaichi plans an assertive expansion. She has proposed major public spending increases in several areas, notably infrastructure and defense. This means funding new highways, ports, digital networks, and resilience projects, like upgrading aging infrastructure prone to earthquakes, which she argues will stimulate jobs and modernize the economy. It also means sharply boosting Japan's military outlays. Under the previous Kishida administration, Japan had already committed to raise defense spending to 2% of GDP by 2027, from roughly 1% historically, a nod to growing regional threats. Takaichi not only supports this plan, she has signaled she'd accelerate and possibly expand it, channeling money into military hardware, cybersecurity, and dual-use technologies. In her platform, she positions defense investment as both a security imperative and an economic stimulus, pumping funds into domestic industries like shipbuilding, aerospace, and tech R&D. Essentially, she's embracing a guns and butter approach, spend on the military without neglecting civilian needs. Beyond defense, Takaichi has promised sweeping tax cuts and subsidies aimed at households and small businesses. For example, she has floated the idea of temporary tax breaks on fuel or everyday goods to buffer consumers from inflation. She's also advocated refundable tax credits or direct stipends for low and middle-income families to raise disposable income. In the campaign, she criticized the idea of raising the consumption, sales tax further, saying no hike should happen for at least a decade, and instead hinted at cutting certain taxes to spur consumption. All this amounts to a fiscal stance far looser than that of her immediate predecessors. In fact, the IMF recently warned that Japan's policymakers should be cautious about large-scale tax cuts or blanket energy subsidies, as those could undermine efforts to fix public finances. Takaichi, however, is prioritizing growth over austerity. First, get the economy growing, then we'll have more revenue to fix the debt. That is her philosophy in a nutshell. Of course, a government can't just spend and cut taxes with impunity. It must fund those choices. Japan will likely issue even more government bonds to finance Takaichi's stimulus. The prospect of extra borrowing has already nudged up long-term bond yields. Japan's 30-year government bond yield climbed to around 3%, hovering near multi-year highs on fears of fiscal slippage. Investors are watching to see if Takaichi will outline a credible long-term plan to stabilize debt, even as she opens the fiscal spigot. For now, she and her advisors maintain that stimulating growth is the prerequisite to fiscal health, echoing the supply-side argument that a bigger economic pie yields more tax revenue down the road. It's a risky bet with the debt overhang so large. But politically, her emphasis on visible improvements, like new public works, cash in people's pockets, and a stronger military, is aimed at quickly restoring public confidence. One might call it feel-good economics, wrapped in the flag. Monetary policy. Easy does it, for now. On the monetary front, Takaichi inherits a Bank of Japan that has only recently begun stepping back from ultra-easy money. The BOJ, under Governor Kazuo Ueda, spent 2023 to 2024 carefully dismantling parts of its massive stimulus. It ended its negative interest rate policy, which had been in place since 2016, and phased out yield curve control, a policy that had capped 10-year government bond yields near 0%. By January 2025, the BOJ had raised its short-term policy rate to plus 0.5%, up from minus 0.1% a year earlier, officially exiting the era of negative rates. This pivot came as inflation hit the BOJ's 2% goal and wage prospects improved. Markets currently expect the BOJ to continue gradually hiking rates in coming years toward a more normal level. The IMF projects Japanese interest rates could rise to approximately 1.5% over the medium term, roughly a neutral rate, consistent with stable 2% inflation. In other words, absent political pressure, the BOJ would likely tighten a bit more, slowly, to prevent inflation from overshooting. Takaichi, however, has signaled she's not eager for much more tightening, at least not soon. Upon winning the LDP leadership, she bluntly stated that the government must be responsible for fiscal and monetary policy, and that the BOJ should then use appropriate means to support growth. This was widely read as a shot across the bow of BOJ independence, a reminder of the Abe days when the government pushed the central bank to flood the economy with cash. Analysts expect Takaichi to interfere, informally, to keep monetary policy looser for longer. In fact, a former BOJ board member, Takahide Kiuchi, warned that her remarks, show she has little respect for central bank independence. It's quite likely she will try to keep rate hikes in check, leaving BOJ officials alarmed at political meddling. Takaichi has allies among noted dovish economists. For instance, Masazumi Wakatabe, a former deputy BOJ governor who is close to her camp, has argued that with Japan's economy still soft, the BOJ will find it hard to justify raising rates further in the near term. We can expect, then, something of a tug-of-war between Takaichi's administration and the central bank's technocrats. The BOJ doesn't want to fall behind the curve on inflation, but Takaichi doesn't want the nascent recovery strangled by premature rate hikes. How might this play out? Likely in subtle ways. Through forward guidance and jawboning, Takaichi's government could appoint sympathetic voices to BOJ board vacancies and emphasize in public the need to coordinate policy, a euphemism for the BOJ supporting government goals. We might see the BOJ move more slowly on rate increases than it otherwise would, especially if inflation eases slightly. Indeed, Japan's core inflation has been decelerating in late 2025, from a peak of 3.7% in mid-2024 down to around 2.7% in August 2025, which gives doves an argument to pause tightening. However, the BOJ also knows that delaying too long could backfire. Prolonged easy money risks a sharper yen decline and inflation flare-up. Delaying rate hikes for too long could lead to a further sharp decline in the yen and worsen consumer inflation, which has been politically disastrous for Takaichi's predecessors, one analysis noted bluntly. In other words, if she tries to force the BOJ's hand to stay ultra-loose, the punishment may come via markets instead, a sinking yen and rising import costs, which would erode public support quickly. To manage this balancing act, Takaichi will have to signal support for the BOJ's gradual normalization, even as she urges caution. It's a delicate messaging dance. Reassure markets that she won't let inflation get out of hand, while reassuring voters she's fighting for growth. Some have dubbed this her real test as an economic leader. As Dr. Hiroshi Nakaso of Keio University puts it, Takaichi's challenge will be resisting global rate hike pressure while managing Japan's inflation expectations. In practical terms, that means engaging with an international environment of rising interest rates. The US and Europe have spent 2022 to 2024 aggressively hiking, without letting capital flight tank the yen. If global investors demand higher yields to hold Japanese bonds, Takaichi will face a stark choice: allow the BOJ to hike more and upset her domestic agenda, or hold the line and risk market turbulence. So far, her administration in waiting leans toward dovish pragmatism. They know some tightening may be inevitable. For instance, if the yen were to plummet past a pain threshold, say 155 to 160 yen per US dollar, the BOJ might hike to stem capital outflows. Takaichi has hinted she would tolerate a near-term rate hike if yen weakness becomes too severe, because a free-falling currency would hammer consumers. In essence, her stance is, avoid raising rates unless absolutely necessary, and if needed, do it grudgingly and slowly. This puts Japan somewhat at odds with the global trend, and it means the BOJ under Takaichi's tenure could remain one of the last dovish holdouts among major central banks. C. Economic security and nationalist economics, build and protect. The third pillar of Takaichi's economic plan is what she calls economic security. This concept, increasingly popular in Tokyo, means safeguarding critical industries and supply chains for national security reasons, even if that requires heavy government intervention. Takaichi embraces this fully. One headline example is semiconductors, the brains of modern technology. In 2024, Japan's government pledged a massive 732 billion yen subsidy, about $4.9 billion, to help Taiwan's TSMC build a second cutting-edge chip factory in Kumamoto. Takaichi strongly supports such subsidies, framing them as investments in self-sufficiency. We must ensure stable supplies of strategically important goods like chips, batteries, and vaccines, she argues. The TSMC deal, coming on top of an initial fab already being constructed with government support, will bring advanced 3-nanometer chip production to Japan by 2027. Tokyo explicitly justified the spending as necessary to revive advanced semiconductor manufacturing and harden supply chains against disruptions as tensions with China grow. In other words, paying billions to bring foreign chipmakers to Japan or bolster domestic ones like the new Rapidus consortium is seen as a price worth paying for resilience. Takaichi will continue or even amplify these industrial policy moves. We can expect more subsidies for high-tech industries, from AI and robotics to EV batteries and rare earth processing. Government-guided investment isn't new to Japan. It harks back to the MITI-led boom of the 1960s, but now it's being justified in terms of security and anti-China strategy. For instance, Takaichi is likely to fund projects to diversify critical imports, like sourcing rare earth minerals away from China, and to fortify food and energy security, increasing stockpiles or domestic production. The Economic Security Promotion Act of 2022 gave the government broad powers to review and direct private sector efforts in sensitive areas like telecom, energy infrastructure, and supply chain vetting. Under Takaichi, this act will be energetically used. Companies could be directed or incentivized to build redundancy, e.g. multiple suppliers for key components, with government footing part of the bill. It's a more dirigist approach than Japan has taken in recent decades, signifying a partial return to industrial policy by the state. Another facet of economic security is tightening foreign investment controls. Here, Japan has already made waves by significantly lowering the threshold for government screening of foreign investors. Since 2020, any overseas investor acquiring 1% or more of a listed Japanese company in designated strategic sectors, defense, nuclear, semiconductors, etc., must file a prior notification and could be subject to rejection. This is a drastic change from the old 10% threshold and reflects concern about foreign, read Chinese, influence over key firms. Takaichi is a proponent of these strict rules. We might see her government expand the list of core sectors requiring screening, or more rigorously vet foreign acquisitions of land near sensitive facilities. Her stance is unapologetically protective. She's warned of tech leakage and has even cited incidents like foreigners kicking deer in Nara Park as a metaphor for disrespecting Japan's home turf. The deer-kicking comment was an odd anecdote, but it telegraphed her alignment with those who feel Japan has been too open and naive in some respects. Now, with her in charge, expect FDI, foreign direct investment, to face heavier scrutiny if there's any whiff of national security concern. Chinese companies, especially, will find it harder to invest in Japan's tech, finance, or infrastructure assets under Takaichi's watch. Even allies aren't entirely off the hook. She has hinted that if an investment or trade deal term undermines Japan's national interests, she's willing to revisit it. What underpins this economic security push is a kind of nationalist economics. Takaichi combines a desire for self-reliance, whether in chips or food or defense equipment, with a willingness to marshal government resources to achieve it. It's Japan taking a leaf from its own post-war playbook, but updated for the 21st century great power competition. We see similar trends in the US, with its CHIPS Act and protectionist tilt, and elsewhere, so Japan is not alone. But Takaichi's fervor stands out. She often speaks of protecting Japanese technology from foreign siphoning and ensuring strategic industries remain in Japanese hands. Concretely, her policies will likely include more funding for R&D in quantum computing, AI, biotech, to keep up with the US and China's tech race, tighter export controls on sensitive equipment, continuing the ban on advanced chip manufacturing tools going to China, for example, and incentives for Japanese firms to onshore production of things like drones or pharmaceuticals, critical for security. Critics worry this could veer into economic nationalism that isolates Japan. If every major power tries to subsidize and wall off key sectors, global trade could suffer. Japan has long benefited from globalization. Its manufacturers thrive on international supply chains. If Takaichi's policies inadvertently provoke trade partners, say if the US feels Japan's subsidies undercut American firms, or if China retaliates against Japanese businesses, it could harm the very growth she seeks.